to talk taxes. We mentioned in the 2-1 video that there are 4 required taxes that come out of your check. The purpose of those taxes were not yet explained. So here's what we know. The government collects money from citizens and businesses in the form of taxes. That money, those funds that we pay the government, are called revenue. So write this definition here. Revenue is the incoming funds to the government. The government spends the revenues received according to what's most important, and that's determined by Congress. So if you are going to pay income taxes, they call that progressive taxing, meaning the more money you make, the more money the government takes. So a larger share of income as the amount of income grows. Federal taxes are progressive. So the people in our country that make more money actually pay a higher tax rate. Regressive taxes are when a smaller share of the income gets taken out as the amount of income grows. For example, sales tax on stock is considered regressive. If I have $100 and you have $10 and we buy the same thing and pay the same amount of sales tax, a littler amount will come out of mine because I had $100, where your $10 bill is probably going to disappear faster. Sales taxes are regressive. Proportional tax is the last type of tax, and they call it a flat tax. And that's a tax at which the rate stays the same no matter how much money you make. So if I have a 2-bedroom, 3-bathroom house with a pool next to another 2-bedroom, 3-bathroom house with a pool, those both are going to have the same property tax value. So both owners, no matter how much they make, are paying the exact same amount for property taxes. Make sure you have the full definition of each of these taxes, including the example at the end, so we can discuss them further after the episode. There are many components to our tax system. You've probably heard the term IRS, or the Internal Revenue Service, especially right around now because we are currently in tax season. You've probably seen a lot of commercials about the IRS. The IRS has the power to tax. They come up with a lot of the concepts and changes. You want to make sure that you pay your fair share. So tax rates apply to income ranges or tax brackets. So your definition of a tax bracket is an income range. I'm going to show you what that looks like right after we're done the Ed Puzzle, but just so you know, if you make between $0 and $10,000, you are in one bracket. From $10,001 to say $15,000, you're in another bracket. So it's like a range, and that's how they determine how much should come out of your money for their taxes. Our income tax system is based on voluntary compliance, and here's the definition for voluntary compliance. It means that all citizens are expected to prepare and file their taxes without being bugged. The assumption is you're going to do it, and there's penalties for not doing it. So failing to pay taxes can result in interest and fines. If you choose not to pay your taxes, that's called tax evasion. So here's the definition of tax evasion. This is a serious crime. Could end up in big fines, you could go to prison, or have to deal with both. Every year, the IRS calls millions of taxpayers for an audit. An audit is an examination of your tax return. So they come in and they check to make sure you did everything right. So again, these 4 words, we look at the brackets to decide how much you have to pay. We expect you to pay willingly. If you don't pay, there's trouble, and we check up on you every once in a while to make sure you did it right. Filing status is a way that they describe how or who is filing. So filing status describes your tax filing group. You have to pick one, and usually it's pretty easy to decide. Single, you're not married. Married, you could have a husband or wife file with you together. Maybe you could file without your husband or wife, even though you're still filing under married. Then there's head of household, if you're taking care of an elderly relative or child but you're not married. married. And then there's qualifying widow or widower. So you're filing as one in a marriage where the person passed away. The government wants to know these things to know how to categorize your taxes. Exemptions is the amount you may subtract from your income for each person who depends on you to live. So, every dependent you have becomes an exemption. Remember, the government chooses your taxes based on how much you make. If you make $20,000, but you have 2 kids, you can take that out, which means that it lowers the amount that the government will tax you on. Exemptions can be yourself, unless your guardian is claiming you. So usually minors are claimed by their guardians. Your spouse, if you're filing jointly, or children or older relatives. Those would be considered dependents. Dependents are someone who lived with you, has to be living with you, and for whom you pay more than half of their living expenses. Make sure you have these 2 definitions in your notes. As you're making money throughout the year, whether you're earning it or not earning it, the government is going to track to know how much taxes you have to pay. Here are the ways you earn your income, meaning the money you did and received from working. Wages, salaries, and tips. We know these 3 terms. What you might not have known is there's also something called unearned income, and you have to file that as well and let the government know that you receive money from doing something other than working. Like you got interest on your bank account. You had some stocks and they paid some dividends, which is extras. Maybe you have to let them know about alimony, meaning your ex-husband or ex-wife is paying you money. Maybe you had some unemployment time and got an unemployment compensation. You still would have to pay taxes on it, and workers' compensation. So even if you were injured on the job and got a workers' payment, you would still have to pay tax on that money. The money that's not taxable is this category right here: child support, life insurance, and veterans benefits. Taxable income is the income on which you will pay tax. So go ahead and put that definition into your notes. These 2 categories and everything that fall in them are considered taxable income. The law allows you to subtract some stuff from your gross income, meaning the amount of money that you have in your bank account or in your paychecks before taxes. It allows you to subtract some so that you don't get taxed as much. What they're saying is that you can adjust your income by subtracting such things as money you've put into your retirement account. You can subtract student loans if you have them, or you could also subtract the money you're paying for current student bills. These amounts are subtracted from your gross income, and what they now call it in the end is adjusted gross income. So the gross amount minus adjustments equals adjusted gross. At that point, the government will have a final number to know how much you paid in taxes. All of your taxable income, remember, these 2 things are your taxable income, comes from all of this. So I have the amount of money I made in the year, and I make some adjustments because I have some scholarships or loans that I'm paying off, not scholarships, loans. So now I have adjusted gross income. Then I take out some deductions, like I have 2 kids, or maybe I'm taking care of my elderly grandma. And then there's something called exemptions. So all of this comes out of that big number at the top, and you're left with taxable income. We're actually going to do this process using your job analysis later on. One big thing, one way that many people have chosen to go ahead and do their taxes is by deciding whether they get a standard or an itemized deduction. And what that basically means is you can subtract a bunch of expenses. Here's the list: your dental bill, your taxes, your home mortgage, if you gave money to charity, if you've moved. A lot of those things can be made into a list, and if it reaches a certain number, that's how much money the government will calculate into your taxes. Let's just say the number's $10,000 and you made this big list and you only had $6,000 worth of deductions. You would choose this category then and choose standard deductions. So this is an exact amount you can subtract from your gross income, and you don't have to have a list of things to show. So some people will do this because it makes it easier. Some people save every receipt and eventually will make more money back. Make sure you have these two definitions, and we'll discuss this more after the show. Tax credit is the last term I want to go over from these slides, and a tax credit is the amount subtracted directly from what you owe. So after your accountant or H&R Block or TurboTax does all of the paperwork for you, and they'll say, okay, you owe the government $600, you could then have it subtracted to make it $500 because of things like child care, maybe some medical bills, whatever the case may be, deducts from the amount deducts from the amount you owe the government. It sounded like a tongue twister. The whole goal of doing your taxes is to give the government the least amount of money possible so you have it for yourself to live on. So there's many different tricks that we're going to talk about that'll show the government you've made less money. That's all for now. Make sure you have the terms tax credit, itemized deduction and standard deduction, adjusted gross income, taxable income, and the definition of these three, or two as well, unearned and earned. Here's their definitions right underneath. Exemption and dependent, filing status, tax bracket, voluntary compliance, tax evasion, audit, revenue, progressive, regressive, and proportional taxes.